Hey there, how you doing? Welcome back to the channel. So today, going to be stock update for Monday the 28th or whatever. Um, so we're just going to go over some of the stock, what's been going on in the stock market today, have a little chit chat about that and talk about some of the things going on. So I think that is what we are going to do. So let's go ahead and do that. And let's see. So here I want to go ahead and I'm going to share this screen. Okay, so for today, what's going on? Let's start out with the wide-ranging SPY. So for this SPY, as indicated by the spiders, which is the S&P 500 ETF, of course, is slightly different than the actual S&P, but it's close enough for government work. So today we're down a little bit, 0.05%. It's really interesting because we're really at all-time highs here that you can see, and that's kind of where we're at. Then if we look and we go to the composite, NASDAQ composite, you see that we're still kind of down. So NASDAQ had corrected, came up to the 50, couldn't really hold it, and the 21 is now crossed over the 50. Now it's interesting, the 21 is kind of flattened here because we've had a little bit of a recovery here. But today it's down 0.6%, so not really a big deal either way. And then one of the other industries, the wide-ranging ones we can look at is XLP, consumer staples. So this thing, let's see, I want to look at the 3-month. That's not fair. Yeah, so if you look at the 3-month, I mean, today it had a good day. It had a 1% up. So this thing is running right now. If you look, since this low in March, it's been running. It's just having one heck of a run right now. So this really is going to bring up what the conversation is for today. So first of all, like that, the tanker is unstuck from the canal, so traffic is moving again. So there's kind of worries about, what effect that would have on the economy, whatever. So that's definitely a transitory, short-term kind of thing. But what we want to look at here, let's look at what happened in bonds today. So look at the big picture bonds. We see that, we're still at relatively, we're talking years, we're still in relatively low rates. But what has happened is, this is a weekly chart, long term. We see that we've had this run up since August of last year. So we had a run up in bonds. Now, today we did actually have somewhat of a move in our bonds. So it's interesting. So today, there wasn't really a big correction in the indices, but if you look, you had a decent move over here in bonds. I mean, it was up 3.67%. The yield was up 3.67%. So now if you look at these bonds, bond yields on the 10-year, it's kind of an interesting thing. Basically came down to the 21-day, found support, and you see how your your slow stochastic is flipping over to indicate that it's kind of going up. Stochastic lags, it follows what the price does, but you can see that it's found support after moving, and so this uptrend is basically intact. So the uptrend in yields on the 10 is on track right now. That's what it's doing. This is like a fact. That's not an opinion, right? And then if we look at the big deal, you got to understand we're pushing well into this right here, into this resistance. We've pushed into this zone, which is technically the resistance, and now we're into here, and there'll be more resistance here at these tops along with this consolidation, but it's there. So now let's look at the dollar. Big picture dollar's been running here, running up, and you can see that over here. And with the dollar, so this is the weekly chart, long term. You can see that it's causing the long averages to flatten out. So you may have a trend change in the dollar here. It's very interesting. We may have a trend change in the dollar. And if we look at the 3-month, so we can see that the dollar moved up, actually not a lot today, 0.2%, but that's a decent move on the dollar. And let's just go to a 6-month or yearly daily. So yeah, you can see it on the daily that, it's pushing into, and now it's getting over the 200-day moving average. So this is, the dollar's moving up. So in a way, it makes sense, right? The dollar's moving up, and you tend to see that, the currency where the rates are going up tends to rise. And, whatever the reasons are for this, one of the, the different reasons for cash going in and out of different currencies, one of the theoretical things is like, well, if you're getting a better return, right? So basically, look, if you were looking at the 10-year yields and you're like, oh, gee, I want to get some of that 1.7%. Well, first you have to what? You have to go into the dollar, buy some dollars, selling whatever it is, euros or whatever, get some dollars, and then you can go buy the treasuries. So that's why when you see interest rates go up, often the currency goes up with them, and they kind of go in together sometimes, and it's not all the time, it's not 100%, but this is why you have cases like the lira, like Turkey and other countries that are having currency problems. The central bankers will try to raise rates, but they'll get a lot of resistance because that damages the economy. But they try to raise rates to encourage money to come into the currency to support the currency. So that's kind of why they do that. So overall, not really a bad day. It's just, but so if we go to the high beta stuff, we have high betas, 2.5% down. ARC Innovation. This is holding support right now at this low down here. So basically, if you looked back here, 108, it's holding that low. You see these little wicks coming down, it's touching it and bouncing off. So, okay, that's positive. Churchill Capital, well, today had a down day, 7% down, but the problem is it closed near the lows, which is near the lows of the previous lows. So it's really at risk of punching through there. That's the problem with that one. Phase, another one of these guys. So a typical pattern, we have the 50 going down, the 21-day going down, and you've pushed and you've struggled. It's basically riding the 21-day moving down, and today is no different than that. GameStop, the one exception in this high beta space, just something's going on with it. So someone's got something going on in there, a big one. And then we have our NEO doing this, holding the support right now. You can see that in this area somewhere there's some support and it's bouncing off, but it's not necessarily really strong, but it's holding it right now. So, okay, fine. And Tesla kind of holding too, isn't making it to the previous lows. So in a way, it's a little stronger than some of those other stocks, you see, because it didn't go as low. And it's as low relative. See, you look at it as percentages, you can look at it, but you also can look at it as relative moves relative to the previous low in the cycle that you're looking at. So like here, you have other stuff that's pressing at the low from March 8th, right? It's pressing at the low, threatening to break through, whereas Tesla is a little bit stronger than some of those other stocks because it's got room to run before it actually gets to the place where it could break through to new lows, right? So that's kind of, one of the things. Now, interesting, oil went up today, 1%, really not a big move, but except, we'll zoom out here to the weekly chart on this, and we'll just make note that, similar to the dollar, we've had this, it got beat up, and then now we're running up on the weekly chart. So we're kind of running up. So oil is now in an uptrend for sure. So that's something to keep in mind. So, so this is why, like XLP, I don't know. I mean, this is not financial advice, but that's why I've moved something into that, because it's just because looking at the charts, I just assume, number one, I assume that I'm dumb and I don't know what's going on. I just observe with the chart. I just observed that this thing was getting stronger relative to the S&P in the short term. So that's why I put a little in there, but it is still just widely, very widely, sort of have the indice for the majority of what I have, because I just don't want to take, it's just too much. If you want to trade every day, that's great, but it is a lot of work. If it's not a lot of work, then you may be in a situation where you're, and it seems easy and stuff. Well, you want to be careful. There's that famous saying, don't confuse brains for a bull market, And I think we got a lot of that going on right now. So yeah, here you can see an XLP that it really moved from this low in here, same low on S&P, and it really ramped out a much, much larger move. So I think the thing to talk about here is, what's going on here? Have the BondVigilantes returned? This is something that has like going out, and this is something kind of really important, because what's really going on here is if you look, here's the 10-year yield over years. We're going back to the 90s. And it's been going down this whole time for the most part. But the important thing, if the yield's going down, the price is going up. So this means that this whole period of time, there's been lots and lots of demand, in this case for the 10-year Treasury bond, okay? And during all this time, starting back in 98, they printed a bunch of money, right? Then in 2000, print a bunch of money. And then in the 07, 08, print a bunch of money. And then now they print a bunch of money. And in all this time, the bonds have still supported, there's still been lots of demand for the bonds. And there's this concept that goes back to like the 70s or 80s, it's like called the bond vigilantes. And the bond vigilantes are the bond investors. They're like, hey, if they see that the Federal Reserve is encouraging banks to get out of hand with lending, that this can be inflationary. And the bond vigilantes have come out, and they are, in the past, in certain periods of time back in the 70s and 80s, they were the ones that prevented the Fed from doing more stimulus, et cetera, keeping rates lower than they otherwise would. Because basically, if the bond investors start selling and not buying, then the rates start spiking up. And that, of course, damages the economy. And that's what we're seeing here. Now, we have the Kevins of the world that are like, hey, you know, this is all crap. This worry about inflation is just nonsense. He's like, you know, it's nonsense, and, you know, kind of aggro because, you know, of course, his stocks are getting hit. His high beta neos of the world are getting hit. But here's the thing. And then, of course, you know, there was a study that was done where they asked all these professional economists and stuff like what their inflation expectations are for the next 5 to 10 years. And of course, all their inflation expectations were very low, you know, and this was a Fed done survey, I believe. Yeah. Or a BLM survey. And, you know, of course, the highest is like 3%. Oh, we're not more than 3% inflation. But here's the thing. These are all the experts that, as I've explained in one of my other videos, that they are part of the system, and therefore they are spokesmen for the system. So they're spokesmen for the Federal Reserve System, where the Fed just, you know, comes out and says, well, we have to do whatever we can do to save the economy. So we're going to feed the banks with as much reserves as we can feed them. We're going to buy as many mortgage-backed securities and other stuff we can buy to just, you know, encourage the banks, basically to try to, you know, pile up the reserves on the banks to try to encourage them to lend to get that money into the economy, right? But here's the thing. If those experts are, like I said, they're spokespeople for the system. But we have this study, and I pointed out in my video yesterday, this is from Civic Science. How concerned are you right now about inflation in the US? Very concerned is 42%, somewhat concerned 35%. So you put it together, you have 77% of people are somewhat or very concerned about inflation. So you compare that to study from the experts that aren't concerned at all because they're like 3% inflation. That's the most we expect within the next 10 years. So they don't care. But these are the people. These are the 77 of the people are concerned about it. And then it's interesting too, because as I was pointing out before, I'm surprised that the younger generation, 18 to 24, they're worried about it too. So here's my point. And this really is just going to get, you know, really to the point that I'm trying to get to. I think the first thing is, you know, hey, I'm dumb. I could be wrong. But, you know, we have to put all the data points into perspective. We have a data point, you know, Kevin had this study from the Fed or whatever, and it shows that the expectations of the experts is that inflation will be very low, or, you know, go to maybe 3% or maybe a little higher in the next 10 years. So, you know, if I see that, I'm like, yeah, sure, I agree with you. I don't care. But then I have other studies that, like this one, that interviewed people and found that 77% are concerned. So the question is, whose opinion matters? See, here's where the problem is. Whose opinion matters? Well, the reality is the opinion of the experts does not matter because they're out there behind the curve. They're behind the curve. The average person out there, what that study is showing is that the average person isn't buying it. They're concerned about that inflation, right? So, you know, you only have a couple thousand Fed people and economists, maybe you have 50,000 in the US alone or some number like that. Okay. But you have 300 plus million people. So it really doesn't matter. It doesn't matter what the 100,000 think. It really matters what the 300 million think. And so that study is, I quite frankly was shocked at it. And I was quite frankly shocked at how the younger generation was concerned about it. So putting that all together and just looking at what I see with the market doing, you make your own decisions. But to me, it's looking like inflation is a concern. And I think it makes perfect sense from the point of view that, I mean, if you ask the average person, I mean, I understand they don't get it, right? They don't get it. But maybe this shows that the average person has got a little more intuition that we give them credit for. You know, maybe the average person is like, gee, I just got my second or third stimulus check within a year. And you ask the basic question like, hey, why don't we just send everyone $1 million? Well, why don't we do that? And maybe the average person isn't so dumb, for lack of a better word. Maybe the average person has an intuition that like, well, gee, if we just gave everyone $1 million, that just can't be right. Something would go wrong. And then they start thinking about it and maybe think like, well, maybe the thing is that would go wrong is that we'd see inflation. It would be a race between, you know, how fast I get to use the money before the price of everything goes up. And so this is a really interesting thing. So just based on what I see, you know, my kind of view is that, and this is not financial advice, but my view is that, look, at least right now, in the current situation, it looks to me like inflation is the concern. Because at least, and here's the thing, it's really that's the market's concern. And stating that, hey, these people are whiny, cryy babies for being concerned about inflation and selling the high beta stocks, that really doesn't solve any problem, right? If you're sitting there and the stock market's down 1% and you're down like 20%, you know, you have a problem, right? And you can make all the excuses you want to make, but you got your own problem. And if you want to be in this game for the long term, you better figure out what the heck your problem is, because you won't be around very much longer. You can blow out, everyone is capable of blowing out whatever size account they have. Bear Stearns investor, billionaire guy, oh, I'm going to buy more Bear Stearns. As the stock drops in half because it just becomes apparent that, oh my gosh, they're going bankrupt. You know, money doesn't make up for really anything, right? There's plenty of people making bad decisions, and the thing is, like I'll say, it's not dumb. It's not dumb. That's not the right word, but it's like ill-informed decisions, or decisions where you overestimate your skills. And this is where that statement comes in so well, where it's like, hey, don't confuse a bull market for brains. And that's just what I see. Now, given that, what I will say is that if I look at these charts, so I just been like dumping on everyone, right? And saying like, oh, you Kevin type people buying all these stocks and doing all your predictions on where they're going to be, you're full of it, right? Well, yeah and no. I'm looking at it and I'm going to look at this stuff too. And so once again, not financial advice, but for myself, I can acknowledge my biases, and my biases are against stuff like this, like Tesla, for example. But you know what? I'm looking at it. Because if this thing does end up holding this low and start working its way back up, and this thing flattens out and the moving averages flatten out, this very well, in my opinion, I may buy some, right? And so that's the kind of thing I'm looking at. So I'm not like this opposed to anything. I'm not, I'm just looking at the facts as they are, just looking what's happening to the yields and happening to the dollar and happening to oil prices and happen in the surveys that are coming out that I can see. I'm just looking at the evidence and trying to base my decisions on that. Do I think that this could be a good setup for Tesla going higher? Yeah, actually I do. Because if I look at this, this is, okay, once again, not financial advice, but this is not as it stands right now, this is not like a great double top type of setup. This is more of like a consolidation type of setup, in my opinion only, not investment advice. So that's why, I'm looking at it, and, and that would be the question. If I'm going to go out and do it, like, would I buy Tesla or NIO? And they both have similar setups, but you can see NIO is a little weaker in that it's pressing against the previous lows a little more than Tesla is. So, that's something I'll do, is I'll go do my research and figure out if I want to buy some of this, and I may. And so this is kind of an important thing, I think, to understand when you're listening to people. You have to kind of figure out, are these people flexible? Are these people blinded by their own biases, right? And so you look at me, and if you listen to my stuff, you think, oh, I'm biased against the EV and the high beta stuff, and I am biased against it. I'm biased against it because it's performing like crap right now, and it isn't really a good place to buy in. And that's the other thing I will just point out. See, if I'm thinking of getting into this, this is going to be a one, maybe two buys split up into like two little buys of a relatively small chunk of my portfolio, right? And the problem, and the thing I had the most annoyance with Kevin and these other people, is that they were just looking at 5-minute bars every day, buy, until the point where you don't have any more money to buy and you're extended on margin. And by the way, you're paying interest for that margin. And what do we get paid in a savings account? Well, 0.00001%. What are they charging on margin? I don't know, 12, 13, 20%. They're making money on the margin they're lending you. So I don't know what it is. I don't deal in margin, but it'd be nice if you kind of like confessed up to what that is actually costing you. So, all right, let's get back. So today, the current trend seems to be in place. And as such, it's just kind of chill, just kind of chill. So I think that the significance of what's happening is that it could be the bond vigilantes are back. And this is the one thing the Fed, and I don't, it's so hard to say, because the Fed has the ability to get people to buy the bonds. I mean, they have all this ability, all these things going on where they can just, coerce the banks into buying the bonds to lower the yields. Yet they haven't, or they have, and they're not doing enough. Now, the counter might be that the Fed is like, look, this is way too low, 0.05, 5 basis points is just way too low for yield. And they're like, we're just going to let it come up to something more reasonable. It's just way too low. Maybe they're thinking that kind of thing. Maybe they're waiting until something breaks or whatever. And they're like, look, and that might be, like, in my mind, a smart thing to say that on a 10-year that you shouldn't be earning at least 2% nominal yield. I mean, it makes no sense. Like, from the Fed, if they had some common sense, they would be like, look, if we want 2% inflation, then we would expect you should get 3% on your bond. And that would be reasonable. That'd be like, hey, you're getting a real return of 1% on a 10-year bond. You'll lend money for 10 years and get 1%. That's sucky, but that's reasonable. Right now, as I pointed out, inflation at 2%, yield at 1.7 right now. So you're earning a negative 0.3% in real terms. Interest rates are negative. So we have all this discussion. We have all this discussion out there of, oh, will rates go negative, et cetera, et cetera. It's like, the real rates, the most important rates out there are potentially negative. And I say the word potentially because I didn't look up the PCE to give you what exactly the inflation rate is right now. extending a little bit, because I'm just saying the Fed wants the 2%. So just assuming that they get to 2% at some point and we're at 1.7, then that's a negative yield. So given that, you can make an argument that the Fed isn't going to start blinking till after 2%. I mean, the Fed shouldn't do anything. The Fed should let it go to 3%, right? Because like the Fed doesn't want to do negative rates, right? They don't want to really mess things up too bad. So, yeah. So okay. So I think that's it for this one. The trends of the increasing rates, the running into less high beta type stable stocks seems to be intact, and so that's what it is, like it or not. Okay, that's it for this one. Bye.